as a way of starting, maybe a show of hands for people in the audience who currently work at or are interested in working at a bank or other financial institution. OK. And a show of hands for people who work at or would like to work at a technology company, including a financial technology company. Yeah, so there we go. Look, this is a sort of stupid thing to do. This is the world's most biased sample. But the underlying point is, I think we're all here because we think something is, or we think something may be happening that's very substantial and significant at the intersection of technology and finance. And we are not alone in this. This is it's always my favorite thing to do, to look around conferences when you go and see how jam-packed the auditorium is. These are the two biggest fintech conferences. And both of these conferences didn't exist in 2011. So as someone who has gone to each year of both of these, I'll tell you the enthusiasm around finance and technology is surging. Lest we all feel like lemmings, I think we can take comfort in the fact that we are in a fictitious company. This is, basically the high priestess of Wall Street, of American capitalism, almost, is Jamie Dimon, who's the CEO of JP Morgan, just a couple weeks ago, and kind of one of these minor watershed moments for financial technology. In the letter to his shareholders, talked a lot about startups. I think, this is what he said. He said specifically, when I go to Silicon Valley, they all want to eat our lunch. Every single one of them is going to try. I think probably a lot of them will succeed, but we'll get onto that. I mean, it's kind of, this maybe seems normal to us living in the Valley, but it's easy to forget what a marked contrast this is in finance from what happened in the era kind of before the financial crisis, is where I'd really put a stake in the ground for how things have changed. But in the 90s, in the 2000s, especially after Glass-Steagall, you had this era of banks becoming more and more efficient. And people talked about Wall Street in glowing terms as the engine of innovation, not just financial innovation, but innovation. And we did have financial innovation. We had things that, in hindsight, many people have challenged and called financial engineering. But that's not how we saw things before the crisis. And in this environment, there actually was not very much entrepreneurship around financial services. If you compared, even though finance is the world's largest industry, prior to just a few years ago, the industry had largely remained almost entirely offline. You looked at IT or media, professional services, e-commerce, travel, sectors where huge portions of the profits from those industry were shifting hands and moving to new disruptive startups. You weren't seeing that in financial services. If you look from 2000 to 2010 at VC-backed companies that got at or near or over $1 billion, there really are only a handful. This is not an exhaustive list, but it's pretty close during this period. And out of the wake of the financial crisis, something happened. I'll put it at the crisis because that's a period of time when the banks started to be completely mired and bogged down in regulation. They had sort of tarnished brands, their own capital and balance sheet problems. And in this environment, you had some really smart entrepreneurs who started to say, not only are the incumbents out, but there's so much that's interesting to do for the consumer. And you saw this next generation of entrepreneurs really just in the last 7 or 8 years who have come in, and now we've had a sort of huge swell of businesses that are, at least on paper, some of them are a lending club and on deck, now being liquid, valued in a way that we just haven't seen in the financial technology world before. And of course, venture capitalists have taken quite a bit of note of this. From 2000, if you sort of take 2009, just a few years ago, to today, we've seen an 8-fold increase in the amount of venture investment in a space where venture capitalists historically have not invested. And venture as a whole has gone up during this period, but financial services has grown over 2 times as quickly. There are a number of reasons for this, and I think we'll talk about this a lot. The panelists will have some really good thoughts and ideas, but I wanted to offer just a few thoughts on what's happening here, what's driving the growth of these global new fintech companies. The first one I'll mention is the rise of millennials. And it gets talked a lot, but 60% of millennials saying that financial products are not built for them, or maybe even more radically for people of an older generation, a third of millennials saying that they just won't need a bank in 5 years. This is a different audience, and it's a very big audience. It's almost 2 billion people worldwide, and a group that is commanding a larger and larger share of financial resources. The second thing, and there's really not enough that can be said about mobile, and I think everybody in this room knows from our own lives, from looking at the companies that have been built on top of mobile, that mobile is a really big deal. But if you think in the context specifically of financial services, there's 2 billion people in the world with bank accounts. Most of those are offline. They're not using online banking. You compare that to, in a couple of years, the expectation that there'll be 4 billion smartphones in the world, 10 billion connected devices. There's just a huge untapped market of people who have never even touched a bank, who can be reached through new distribution channels, which is sort of the other point about mobile. You've had almost a threefold increase in the number of monthly downloads of finance apps around the world. And I think what's significant about this is it opens up the opportunity for new brands to come in and exist along existing brands that have existed for sometimes centuries. So you'll have Venmo, which was started in 2009, or Credit Karma started in 2007, competing in this very sort of important channel for the next generation of folks, right next to Wells Fargo, which was started in the 1800s, and billions of dollars of marketing between then. I guess another point that I think is important on brand. This is remarkable, but of the top 10 most disliked brands in last year, 4 of them were financial services institutions, and this represents a huge opportunity for entrepreneurs who are coming in to try to redefine what it means to be in finance. And you see companies like Funding Circle or Lending Club, or some of the panelists we have today who are achieving NPS or other metrics of brand favoritism that are just far, far in excess of what you would expect from a financial services company. And this is kind of the net result of that. I think this is an interesting graphic. It's not mine, but you're now, because of these new distribution channels, because of the opportunity to build vertically oriented services, you're seeing smart entrepreneurs go and really try to unbundle and take individual things that banks have over the last 40 years cobbled into a single pile and not done in a particularly user-friendly way, and do it in a much smarter, more data-driven and transparent way. Just one last kind of case to really underscore this. This is actually in China, but I think we should be thinking about fintech and what's happening in fintech in a global way. Tue Apr is the name of the money market fund that's associated with Alipay, and literally became in a year the 4th largest money market fund in the world with 80 million users. This is just obviously entirely unprecedented. And if you this graphic comparing it to how long it took to build the Vanguard Prime Fund, this is entirely on mobile phones. Now, of course, Jamie Dimon and lots of his contemporaries have started to actually take note of this as they've slowly shuffled the regulators out of their office. And banks are now, and I think a big question for the panel tonight is, how are banks and other financial institutions going to respond? And so far, they're doing the whole gambit of things, and I think we should expect to only see more of this. They're trying to partner. You saw an example of that, Lending Club and Citigroup joining forces for Lending Club to originate some loans for Citi customers. They're going to compete. You've seen Charles Schwab come out in a very public way with their intelligent algorithmic investing strategy to compete with the likes of Wealthfront and other software-based investing platforms. You're going to see banks trying to co-opt some of the energy and entrepreneurship in the Valley. Fintech Innovation Lab and InnoTribe are examples of accelerators funded by banks. And then, of course, you're going to see banks use the, if we can't beat them, let's buy them strategy. And Jake, who's on the panel, who built Level Money, will be able to tell you at least one story about how that's started to happen. So just introduction of myself and the panelists. I'm a partner at a firm called Ribbit Capital. We're a global firm that looks to invest in financial technology entrepreneurs who are working in this space. We have a great set of panelists today. I'll let them introduce themselves in depth, but we have Baiju, Jillian, Libor, and Jake, and I think they'll have a lot of very good things to share with you guys. So I'm going to invite Baiju up to give just a feature presentation on Robinhood, and then we'll get on to the rest of the panel.
First of all, thanks to Nick for the thorough sort of speech of the state of financial services today. And for those of you that don't know, Ribbit is an investor in Robinhood, and we've had the pleasure of working with them for 6 months, 9 months now, and it's been a very healthy and productive relationship. And thanks everyone for coming. So I'm going to tell you guys a little bit about a company that I co-founded in 2012 with, was actually one of my good friends from Stanford, was my roommate of many years, called Robinhood, which is an online stock brokerage that allows anyone in the US that's over the age of 18 to buy and sell publicly traded companies. We are registered with FINRA and SIPC, so we're regulated in the same way that traditional online brokerages are. And yeah, we've been live on the App Store since December of 2014, so just a couple of months. And I think the most important thing I want to cover a little bit about is the folks that help create Robinhood. We're still a relatively small team, we're about 30 people, but one of the primary differences that is very important about the way Robinhood is run is that we think of ourselves as a technology company that is operating in financial services rather than a financial services firm that has a technological focus. So our team is heavily experienced in technology, a lot of folks from Google, Facebook, strong academic backgrounds in engineering, mathematics, and physics from Stanford, MIT, and Caltech. And so personally, Vlad and I, the two co-founders, were actually undergraduates, like I mentioned, at Stanford, and we studied physics and math. And along with our deep technology experience, we have a regulatory team that's actually been around the block a decent bit too, so experience from places like E-Trade and Ameritrade. And a little bit about what Robinhood as a product does. We believe that for first-time investors specifically, there's no product in the market that is compelling in that it's understandable, translates the functionality of what the service provides in a relatively straightforward way to customers, or in the wake of things that happened like 2008, is genuinely trustworthy. And this is what you pretty much see when you sign up for an online stock brokerage today. It's a lot of charts, a lot of buttons, and a lot of functionality that says to folks that don't already invest in the stock market that if you don't know what this means, this probably isn't for you. And this is something that we fundamentally, as entrepreneurs, as folks of a different generation than these products came from, really took objection to. And one of the main things that we think is really compelling about the transition from interfaces like this is that the entire internet has gone mobile, and the interim between when the last major online brokerage gained any audience to today. So this is kind of how we see the transition from basic services to ones that are centered around mobile go. And Robinhood, as I mentioned, is mobile first, and there's a few things that we think really define its unique character. The first is it's free, meaning if you want to buy and sell stocks, there are no commissions that are charged on every trade. And there's no catch about it. We just don't charge commissions. The second is that it's dead simple. You have to genuinely try to be confused if you don't know how to use the product, or that's at least how we hope people perceive it. And the one thing that we perhaps didn't realize was going to be as significant when we first started working on it is that by by reducing the account minimums for people to get started to a point that there's zero, has really opened up a market of consumers that otherwise feel uncomfortable committing to putting down $2,000 or $5,000 to open up an online investing account. And the analogy that we like to use often is that imagine if anybody in this room, I told you that the first time you used Amazon, your first purchase had to be a $1,000 television. I don't think that many people would feel that comfortable starting out a service where the initial commitment is so significant. And today, we've seen that this focus on simplicity and reducing the barriers to entry has given us a very strong growing audience amongst millennials. So for those of you that know a little bit about Robinhood, we had close to 1 million people sign up for our waiting list for our product before it ever launched. And over the last 3.5 months or so, we've taken our customers off of our waiting list, and we have hundreds of thousands of people in the US today, only on iPhone, that are using Robinhood. So that's something we're very excited about. And coming back to how we see Robinhood as a product, specifically targeting an audience that's a little bit younger, we see Robinhood as having the ability to grow into a market that, for the last generation of Americans, has been really significant. So if you look at the 5 major online brokerages that have defined online brokerage services for Americans before Robinhood, you notice a couple of things. One is it's a tremendously large market. Just those 5 companies together is at least $150 billion of market cap. The second, which we've learned as we've looked at some of the public filings of these companies, is that their customer base is significantly older, and a lot of them don't have a strong customer base under the age of 40, which defines a really interesting opportunity for Robinhood in the marketplace. So right now, while we're still a relatively small company, we at one of our core theses at the company is we believe that this new generation of Americans in aggregate will be as valuable, if not more valuable, from a market cap perspective than the previous generation. And so it's a truly interesting opportunity. And yes, as I mentioned a few moments ago, this commitment to making access to markets much simpler is, we think, the key to this younger demographic. And this is what we see today that's really interesting, is we see our customers are much, much younger than what any of the online brokerages see. So less than 10% of our customers are over the age of 40, which I think for most online brokerages is the other way around. And we see a very strong adoption in college campuses. So for example, there's a lot of folks at Stanford that are really excited about using Robinhood, and we see that phenomenon a lot around the US. As we look across the US, it's been interesting to see that the use of mobile has allowed us to scale pretty quickly across the entire US. So we see the distribution of our customers around the country is following pretty closely with just the population of Americans. And finally, we just want to end the presentation a little bit with some of the things that we see with Robinhood in the near future. And the obvious expansion to Android, for those of you that are interested, is going to happen in the next month and a half, 2 months, maybe 3 months before we start rolling out the beta. And later on this week, for those of you that have Apple Watch, you'll be able to use Robinhood on there. So I think there's a lot of interesting opportunities using mobile as a distribution channel for this new generation, and that continues to stay one of our core focuses. So on that, I will wrap things up.
Join us.
Thank you.
I spend every day of the year, all day looking for great financial services entrepreneurs. I'd say the panel we have tonight, it really is sort of A+, cream of the crop folks in terms of the businesses they're building. So I'll ask Libor and Jake and Jillian to introduce themselves and just to give a minute or a minute and a half about your company and what you're doing. And then we'll get on to some of the questions. And then if you have questions as an audience throughout, I think in 25 or 30 minutes, we're going to turn to answering those questions and just text them in, and we'll make this kind of fun and interactive discussion. So, Libor.
Hi, I'm Libor Michalek, CTO of a company named Affirm, where we are building a better consumer credit product and company. We are focusing initially on a online point of sales installment loan product that consumers shopping online can get a loan at the moment of purchase for the exact amount that they are looking for. We believe that credit card companies have become misaligned from their consumers, and we believe there's a lot of room for improvement through a more transparent and direct consumer product.
Jake Fuentes. A couple years ago, founded a company called Level Money. We are the simplest possible way to manage money. We're designed for millennials. When we looked at the spending habits of millennials, we noticed a couple things. The first was that we spend money on weird things. We buy $12 beers and decorative gourds, and it's really hard for us to categorize our spending. The second was that we were missing, as we moved from cash and checks into primarily transacting on cards, we were missing a really basic experience. That experience is just like the ability to just open up your wallet and see how much money you have left. Like it's gone, right? So we used to be able to hand something over and get something in return, and that was the purchase experience. Now we get our card back too, and that feedback loop of like not having any money in your wallet is something that we've lost. So we decided to recreate that experience. We decided to build a system that automatically analyzes all of your transactions, automatically picks up all your income, all of your bills, sets a little aside for savings, and then tells you if you're standing in line at Starbucks or you're walking into a grocery store, here's what you have left to spend today and remain in the black. So that's the app we launched about 1.5 years ago, and the company was, in January, just recently acquired by Capital One.
My name is Jillian Manus. We are a seed fund. My fund is called Structure Capital. Our thesis is investing in underutilized capacity and excess assets. It doesn't specialize, I would say, in fintech, but we were one of the first investors in Uber. So we look at anything transactional, no matter what. We look at the millennium generation, as all of you do. They will control $7 trillion worth of assets and comprise half of the workforce in 2020. And for us, we look at anything that serves them better, but on the other hand, this whole instant gratification mentality that millennials have, where everything, that the phone is a magic wand, what I call, and if you can't do it on your phone, you can't do it at all. So we worry about that even as VCs. So it's a blessing and a curse that everything is mobilized, and that's something that is part of the conversation, and certainly as we go forward in terms of building the model of financial security and of this country.
Yeah, so maybe that's a great place to start, since it's now come up a couple times, this topic of millennials as a customer to target for the next generation of financial services. I guess maybe, Libor, maybe you can start and tell us a little bit about how millennials factor into your plans, whether you think they behave differently, are they expecting something different, and how do you approach that as a company?
Yeah, I do think that they're expecting a lot that's different. I think they've grown up in a different context than previous generations. I mean, as each generation has different contexts and experiences. So the obvious the big one being the financial crisis, but as well as the changing nature of work and careers and how people approach their lifetime's work and their finances. And so that variability and creates a desire for more transparency into their finances and products that understand that variability. I think a lot of consumer credit that's grown up over the last 40, 50 years is very much premised on the notion of a natural progression that's kind of moving slowly up and to the right throughout your career, and that you're building finances and credit, and your credit line slowly expands to to fulfill that. And I think the nature of work and how people plan their finances and should be planning their finances and how they've grown to think about finances has changed, and we need to catch up to that.
Is that consistent with your experience, Jake, with your customer set?
So look, if we were in any other industry, millennials would be way too broad. Like we'd say, hey, look, we're Snapchat and we're targeting millennials. Like that wouldn't work. But the fact is that there are actually a few things that have changed that make that demographic an appealing one, other than the fact that it's the biggest generation in U.S. history. 85 million of us were hard to miss. The things that have changed is, one, we're in an electronically based transaction, like we're in electronic currency mode here. We try to remember that as ancient history. That inflection point only really happened around 2004 to 2006 is when debit really took cards into the cash and check world, and most transactions became electronic. The other things, though, I mean, the financial crisis, yes, is in the back of our minds, but I think that's kind of a minor thing. The other things that have changed, though, is, first of all, the experience gap is growing. So there's the experiences that you have with your financial institutions, and then there's the experiences you have with everything else. And the everything else category, they're farther ahead in the book and they're reading faster. So this gap between how you expect to interact with services, mobile first, web first, whatever it is, and how you interact with traditional financial institutions is massive. And that I think creates a really big opportunity.
Yeah, it's interesting. You talk a little bit about why now is the time, and I think that's a very common question to ask an entrepreneur or for people who are aspiring entrepreneurs to think about is what's changed, because often you have to admit to yourself you're not the first to have thought of something. The world must be different in a way to make space for your company. So what do you guys think about that? What do you think, Baiju? What's changed in the world, or why is now the time for you guys to be building Robinhood, or for folks who are here to be thinking about starting a fintech company?
Yeah, I think probably the most significant trend is definitely going to be the mass adoption of mobile. I think at least everyone on the stage, and I think a lot of people here, we have kind of an unusual perspective in that we remember a world that existed before our mobile phones were ubiquitous. And there's a generation that's coming after us that's just never going to have that experience where there isn't technology that's always accessible. And so specifically as financial services transitions to being really central to the experience of mobile, I think about what it would have been like if these conversations were had even 4 years ago. And let's just subtract, for the sake of this point, that the financial crisis happened like 6 or 7 years ago. I think the idea of doing banking on your pocket computer would have seemed really scary, right? This idea that well, what if my phone gets stolen, right? This idea of like, oh, what if it gets stolen, was really scary then. I think today when we think about it, it's like, oh well, that seems less scary than my driver's license getting stolen because I can't turn my driver's license off. And so I think as far as building financial services today goes, we as a collective population just feel way more comfortable doing important stuff on our pocket computers. And as a result, you would want to do some of the most important stuff. And I think that's why finance is becoming a significant thing to do on mobile. Yeah.
What do you think about this, Jillian? I mean, you have a good perspective because you look not just at financial services, but is now the right time for financial services, and why?
Yeah, I actually, there are a couple of points. First of all, I'm older than everyone on this stage, so I'm seeing it as a different perspective because we are investing in the millennium generation. We're investing in the next generation. But with that generation and with my own generation, I'm not going to tell you what that is, we are looking at institutions with incredible mistrust. And that in itself I have a 28-year-old, a 26-year-old, a 20-year-old, and a 17-year-old. So I'm very aware of what their mindset is. And that is one that we don't trust institutions with anyone, with anything. we want to be able to control and empower ourselves, and not, we are sick of this lack of transparency. I think this whole mistrust is really, it's a mistrust and it's a mobilization. I'd say M plus M squared here. And I think that's part of why the millennials are so eager to adapt, because you are now empowering them to take full responsibility for their own financial solvency, actually. And I think part of this whole match here, this whole panel, represents some of the very key points of this challenge. One is Robinhood, which can be very addictive. On one hand, it is really quite wonderful and provides opportunity, but it also can be abused. Absolutely, because stock market is one that can be perceived as somewhat of a gamble. It is, and so we worry about that with the millennium generation. Are they going to get themselves into a deeper debt? We have Affirm, point of purchase, that emotional, I'm going to buy this couch and now I can afford it because it's 3 payments or 4 payments or 6 payments. But really, do they really know? Do you really know how you can spend and what you can spend at that very moment when you tap your phone? And then in terms of your tool, well, that to me seems the most responsible, but it also has a component of potentially financial literacy, which is something that I feel the millennials lack in a very big way.
Yeah, let's come back to this topic of financial literacy and how these products may or may not have a social impact. Just while we're on the topic of behavior, because I think this is really interesting how behavior might be changing over time. We've seen, obviously the growth of social networks and online and mobile communities. And finance, by contrast, has historically been a very private thing. So I'm curious whether in your guys' plans and your marketing plans and the way you've designed your product, you think social is an important part of the future of finance. I don't know, Libor.
Well, we haven't specifically targeted social. We're mostly interested in creating direct relationships with consumers. We think about to a smaller extent compared to building out a social product and how people find out about the product, how they interact with the product. But we do think that it is a fairly private business. This is something that's always actually been kind of on our minds as we think about having people take out loans and apply for credit and expose their finances to us, is just how comfortable they do feel with that information. I do think it is one of those things that has sort of reached a tipping point in people's comfort going online and putting more information out there. People who've grown up with it, I feel like it's finally gotten to the point where they feel comfortable just kind of crossing that barrier.
Is that consistent, Jake, for you?
I saw a T-shirt one time that said, the things I didn't learn in high school. How to balance a checkbook, how to buy a car, how to buy a house, how to pay my taxes. But it said at the bottom, but I'm sure glad I know the Pythagorean theorem. The financial literacy, my entire company is about financial literacy. It's about translating the information that's inside the banking industry into something that's real and relevant and usable by consumers. The problem to me isn't that we need more financial literacy. The problem to me is that it's required that entire courses be taken so that people have the basic knowledge that they need in order to navigate a system that is so complex that APR and APY have to become part of our regular dictionary. That to me is the problem. It's not that we need more financial literacy packaged around these products. It's that we need to translate the information that's inside of the banking industry into something that is real, that is usable, that you don't have to walk this very narrow path. And as soon as you trip off it, you go tumbling off this cliff into a self-recurring cycle of overdraft fees and debt payments. That to me is the problem. That's what we need to fix. And then we can look at educating people around that system.
Can I ask you a question? So getting into the stock market, it's taken me 30 years. I mean, I've been creating a stock portfolio and educating myself over 30 years, and I still educate myself every day, right? And I'm just wondering, at what point does your company, or would your company, create more of a deeper analysis into these stocks. So that would really not only create the wealth of the millennium generation, which is one of what you want to do, but it would be also the connection to the companies themselves, which I think is equally as important in terms of really growing a very well-balanced and a more powerful, empowered generation, your generation. And are you going to do that with Robinhood?
Yeah, so I will try to answer your question and touch on something you said and actually come back to what you said, all in one response.
All right.
So the idea of educating customers through Robinhood, our viewpoint is actually very similar to Jake's, which is this idea of what does it really mean to educate consumers about at least what we do specifically, which is investing in the stock market. And we kind of asked ourselves the question, like, is that stuff that we need to educate our customers about? Is it what the optimal investing strategy is? Is it diversification? Is it like monthly returns, annual returns? And what we realize is all of those things are relevant and certainly things that consumers should know, but kind of the basic knowledge of how the entire system works was completely absent. Just what does it mean to buy a stock? What's the experience of buying, let's say, 5 shares of Apple and holding on to that for a month? Like, are you going to lose $100? Are you going to make $1,000? None of those outcomes are realistic. And when we think about educating consumers that literally know nothing about the system, we view Robinhood's place in the greater education ecosystem as being one that allows people to learn by doing.
But hang on a second. So you have something that makes it really easy to trade stocks.
Yeah.
Right. And in some ways, you may give young consumers. You have a young demographic, people that are just learning how to do that. You may give them enough rope to hang themselves. You're giving them an incredibly powerful tool. I mean, but users of Level can't lose money by using Level, right? It's just a dashboard. Yeah. So how do you make sure that the rocket that you've given them is pointed upwards?
Yeah.
So we don't point any of our rockets in any direction because the regulators would have a heart attack if they saw those rockets pointed up and to the right. But I think more the way we think about it. I mean, this is a very real thing that we do think about, and it's the idea of, well, what is a tool that lets a consumer buy and sell individual stocks like? We think of it a lot like starting a fire, giving fire to
fires are dangerous. You realize that?
Yeah. So if you give fire to a caveman, you can either assume that the caveman is going to burn himself or herself, or you can move forward with the assumption that this individual will use this new tool to actually cook the animals that they kill so they don't get poisoning and bacteria down the road. And
how far can we take this metaphor?
From a certain point of view...
What animal are we talking about?
Yeah, so from a certain point of view, our stance on allowing individuals to buy and sell stocks is fundamentally optimistic. That if more consumers in this country do invest in the companies that are taking up a larger mind share of everything that's going on, that long term they'll make more money than leaving their money in a savings account, which is probably going to lose value over time. And we want to be conscious of the fact that a lot of these millennials, again, I personally find it a little silly to refer to our consumers as millennials because I don't know any millennials that call themselves that.
It's on your site, by the way. Sorry. I'm a vulture capitalist, you know.
We want to make sure that we're being honest to how consumers actually learn about products.
I have to agree a little bit. I mean, I think it's easy to talk about financial education and literacy. I mean, nobody's going to argue that that's a good thing, but I think providing information without actual action is kind of an easy and safe thing to do. I think providing products that actually have impact and effect on the real world and deliver something that is a utility and something that functions and delivers something that the consumer needs is in a responsible, honest, transparent way.
No, because I think this is really a central topic, and I want to make sure, if it's of interest to the audience, to go further into the questions around the social impacts of these products. Please ask the question to bring them up. Well, let's bring it back to the product and the technology. How do you think about it, if that's the case, if you want to provide utility or a tool for people to go out and accomplish their financial needs, how do you think about building a product that helps them do that in a responsible or productive way?
I think it's being honest with the consumer, trying to provide them that information on what is actually going to happen. We try to be we do talk about APR, but we try to also explain what that means. You know, you take out a loan for a certain amount of money, exactly what that means on a month-to-month basis. What is the total after the number of months that you've taken out that loan for? So somebody at the point of purchase actually understands exactly how much it's going to cost them in fees, how much it's going to cost them in interest, and get beyond the fine print and just be able to put out a single number of, like, you're borrowing money, you're going to get this product earlier. Here's exactly how much that time value is going to cost you.
What do you guys, I don't know, maybe this is a question for you, Jake. What do you guys think matters to the customer? You know, there are a lot of buzzwords and motivations that get thrown around when you think about starting a new fintech company. I'll give you a few and you can tell me which ones, how you would order them or which one you think is most important. People talk about transparency. They talk about lower costs. They talk about speed or efficiency. They talk about data and the importance of data. How would you rate those?
So we've had a couple of really big wins recently. You know, the two companies that have gone public recently in the space, Lending Club and OnDeck, have both competed on rates, competed on the financial product itself primarily. Lending Club was consumers, OnDeck was small businesses. The big gap that I see in the marketplace is, maybe this is in the transparency topic that section, but like it's taking the actual financial product and applying it to the decision that the consumer, my market's consumers, the consumer is trying to make. Like mapping those two things together, understanding if you're sitting inside of a car dealership and you're being presented a rate by the car dealer, or whatever product is in front of you, whether that or not that's the best thing for you, taking into account not just the headline numbers, but all of the other fees that are associated with that. There's a company out there that's doing like transparent mortgages. Mortgages, like, if anybody's closed on a house here, you get a stack of paper that's like a couple of inches thick that's just impossible to understand. So like making sure that you can figure out where the consumer is and walk them through a decision that may result in a financial product, but actually may not. Like that's where I see a big gap, and maybe that's transparency. Affirm does a little bit of both of those things, by the way, competing on the rate and on transparency. But I think that's where the big gap is.
That's actually one of our companies. It's called Lender, and it's a mortgage. It's a direct mortgage. So it takes 3 months and all the paperwork, and it really gives you it's a direct understanding, a quick understanding, but a thorough understanding, and then a mortgage within more like 3 days rather than 30 days and 300 pages. And that simplicity that you were speaking about, making things easy to understand, that's the financial literacy piece. It's not just the depth. It's that basic, it's taking people through it. We have 3 years of mandatory language in high schools right now. If we were to have 1 year of mandatory financial literacy in high school, that would make so much sense in so many ways. Can I ask a question just about Affirm? So on your site, you talk about taking the FICO scores into consideration, obviously, to create this credit score. Your Affirm score. But then on your site, it also talks about and so much more. We take your FICO scores and so much more. Can you explain to me what that so much more is? These are the tough questions.
So this is something that we're constantly.
I know you've already been financed. You've already been funded. Okay.
We're always looking for new signals. In some ways, I feel like this is almost not controversial. We're always looking for additional signals that we can find, social signals, financial signals beyond just credit score, and applying them as predictive behavior for repayment.
On this topic, big data, machine learning, algorithmic learning. This topic gets thrown around in finance probably more than any other one. So I'm curious whether you guys think this is overplayed, or where does data and the availability of data fit in the stack of the new value proposition that you're offering to customers?
I think we think about it as sort of a necessary but not sufficient condition for success and for building a sustainable business. I think you have to be able to ultimately create a profile of a user that goes beyond what other people are doing to be able to compete on cost. But I do think it's important to put front and center transparency and honesty. I think ultimately, if you are competing strictly on cost, you're in a commodity business and you'll be commoditized. And that is not where you really want to be in the long run. I think if you build a business on honesty and transparency, you can build a brand that consumers love. And I think then you have a very potentially large and sustainable and attractive business. And we do think a lot about honesty beyond just transparency. Transparency is just potentially a lot of data that's not presented in a way that is necessarily consumable by people who don't think about this problem on a minute by minute, hour by hour problem. We think about honesty first in terms of making sure that what we're telling the consumer is also easy to understand and not just a bunch of transparent data.
It's tough because there are lots of companies, Affirm's. I don't know to what degree social media data plays a role in your credit scoring, but there are a bunch of companies out there that have said, hey, we can link your Facebook profile and we'll give you a better loan. I'm not going to say they won't succeed because anything can happen, I guess, but I wouldn't invest in one of those companies. The problem is that consumers only interact with lending companies, between 1 and maybe 7 times in their lifetime, right? And companies like this have the men's hair loss problem. The hair loss solution problem. It's that even if they said that they were the most transparent, most honest, most reputable company out there, even if they were, even if you had a hair loss solution that actually worked, you'd be sending the same messages as every other hair loss solution. So differentiating yourself when it comes to a system that a consumer will only interact with a few times in their lifetime, and making sure that you can send that message with an authenticity that rises above the rest is actually a really difficult problem because you're not going to have repeat customers.
One of our criteria of investment is that to identify a fanatical audience, a fanatical consumer, right? What is it? And each one of you, obviously yours is very fanatical of Robinhood. Everybody needs a loan, and they like to make really quick emotional purchases, which is a good thing, and it can be a bad thing, but at least you enable them to have a bit more responsibility, understand what that framework looks like, and yours in terms of savings. But let's take it a one step further, which is something that you hit upon, which is Facebook and what Facebook is doing in terms of fintech, right? And what it is in terms of creating these profiles with all the data that is coming from all of your companies in order to create now a roadmap going forward, a financial roadmap for each individual. And that's something that data is being used to create these models of individuals' financial success by tracking your behavior. So if you were to now pull from each one of these companies in terms of how often that you buy a stock, how often you have a loan, you take a loan out, and how you can budget yourself, ultimately what's going to happen in the next 15, 20 years is really going to be, hopefully, a plus for your generation, or not your generation, but your generation, because perhaps it's going to create more stability because you're going to know more predictors. You're going to have more predictors from the data that is being collected. So when we invest in a company, we look at the data, not just the product. Yeah, we look at the back end.
Let's discuss another topic that I think is of interest. If I were a skeptic listening to this panel, looking around the room, I would say, look, banks are not newspapers, they're not travel agencies. These are, some of the most profitable, powerful, and IT-intensive organizations in the world. They spend more as a sector on IT, almost 10% of their revenues than anybody else. So maybe they've been asleep the last few years because they've had the regulators in their offices and have had capital constraints, but they're going to come back with a vengeance. And their brands some of them have existed for hundreds of years. So whatever a survey says, these guys are going to wake up and wipe the slate clean. Is this going to happen, and why not?
I think the large, in our cases, the large credit companies actually have a problem that they've painted themselves into a corner with adversarial behavior against the consumer. They've created over time more and more opaque products that rely on consumers misunderstanding exactly what's happening, and that's made them more and more profitable. They cannot easily turn the clock back and become less profitable and make a more honest product. Ultimately, there is going to be a new level set, a new floor on exactly how much consumer loans are going to cost, and that floor is going to come from below and not from above.
I think one of the things that I saw, at least working in finance a few years right after the collapse happened, was this very noticeable exodus of people that wanted to be creative and wanted to try to build stuff that maybe wasn't disruptive in the same way that we think about people that work in technology think about it too. But still, like if we rewind the clock back to 2008, 2009, that period of time, there were a lot of people that were working in finance that just wanted to build stuff that was really good, that was creative, that was forward-looking, that was better. And I think a lot of those people were, they were very disheartened by the way that the industry as a whole had behaved. And so there is this idea that financial institutions are incredibly big, and they are definitely going to protect the value that they've created for so many years. But today, when I look at the same institutions that I maybe looked at 5 or 6 years ago, I don't necessarily see them being, those companies having the same gravity for creative, forward-looking people that they once had. And I think that that's a very systematic problem that can't really be fixed with money or with size. And I think it actually has created a pretty significant opportunity for this wave of new financial companies that are emerging. But I think there's one important point there. Just because we're new financial companies doesn't mean that we are immune to misbehavior. And that's something that we think about a lot at Robinhood is how can the things that we do, kind of coming back to your point, how can we be honest to our consumers, and how can we provide services to our consumers that don't lead them astray? Because I think if we see the next wave of financial companies that are rising, playing fast and loose in ways that the last generation of financial companies did, I think we'll find similar outcomes. So I don't think that there's necessarily that much of a threat of the incumbent technology companies out innovating us, but I think that we run some of the same risks.
Well, and what do you think, Jake? You obviously are now, you're in the belly of the beast. So you must have an opinion about whether you'll be able to see your vision through and how Capital One, or as part of Capital One, you can help them compete against the Robinhoods and the Affirms and other tech-forward entrepreneurs.
Yeah, we don't do stock trading or lending, but look, it's what we wanted to build was a next-generation banking experience. The road to do that, the healthy ecosystem that creates that next-generation banking experience has strong challengers going against entrenched incumbents, and those entrenched incumbents move, and they either succeed and they win back the marketplace, or the challengers win. Like, that's a healthy ecosystem. What we decided was that as part of Capital One hasn't been around for hundreds of years. It's only about 25 years old. It's about the age that Amazon is. And by the way, spending a whole bunch of money on IT is not necessarily a good thing. It's amazing how much money you can throw away into IT. But that dynamic, what we found there was there's some elements within that particular bank that we were like, this could be interesting. I can go more in depth in that if you'd like, but it's easy to paint all banks with one brush and say that these are all big monolithic industries and or companies that nobody has the best interests of their customers in mind. That could be true, but hashtag not all banks. There are some that I think actually stand a strong chance of winning in the industry.
There's such banks like Barclays, all right, that is one of the predominant investors in Fintech. And what they're doing, and a lot of banks are doing, and what a lot of corporations are doing, is they're building incubators. And Barclays is now going to build a very big incubator in New York City, a fintech incubator in New York City. So that is something that we're seeing where they are trying to figure this out instead of what I feel is sort of the Pac-Man, where they are all eating up as many of these small companies and many of this technology, emerging technology as possible. What they're trying to also do is they're trying to get ahead of it and and they're trying to immerse themselves into the pipeline in terms of investing in these startups at the very seed stage. I've been to 7 incubators in 7 different countries over the past 2 months. Yes, I am sleep deprived. And what I've really found out is a lot of these corporations, such as one in Hong Kong, which is called Cemex, it has 300 corporations underneath. It's a real estate company. And they are really looking for as much fintech investment as they possibly in terms of the seed stage. So what they did is they created an incubator in Hong Kong. They provide these these startups 6 months, everything free, and then they pilot all of those companies throughout all their 300 throughout the entire ecosystem.
Do you really think that'll work, though? I don't know. Would you guys ever be part of an incubator program that a bank put on?
No.
Okay, well, hold
Absolutely
on.
Not.
This isn't, all right, well, so Barclays, they have over 700 within the first 24 hours, 700 seed companies, because they're trying to figure out, yes and no. One is a real estate company, right? Siemens is a real estate company in Hong Kong. That's a different play because there are 300 companies and some are hospitals and some are banks and some are different types of holdings. That's a very fascinating answer because the banks are really trying to figure this out. How do they get at the forefront of these companies, of all your companies? How do they get into the pipeline? And is it they have to create the pipeline to get into it?
By building it into the DNA of their organization, you're not going to you're not going to manufacture new products within your by starting an incubator. It's just not going to work.
I think the problem is even beyond the people that you bring in. It's obviously the people and what they're drawn to, but it's also that you're going to be asking them to build products that are fundamentally less profitable than the business that they're currently in, because their business is taking money from a transaction between a consumer and a merchant or a consumer.
So there's been a lot of discussion around this, obviously. It's about, does this cannibalize? I mean, are they really trying to cannibalize? But then on the other hand, they know as much as anybody else, and I hate to use this word, but they need to disrupt themselves, all right? Because they are being disrupted. So,
but shareholders are usually not that forgiving.
Sorry?
Shareholders are not that forgiving.
No, agreed, and yet shareholders are very worried that these institutions are going to become irrelevant, and so they are. If in fact what you are plotting out here is the next iteration of banking, which is what I think you have, then in fact that they are going to become irrelevant, and it makes perfect sense that Capital One jumped in. And Capital One, by the way, is very much on the forefront of innovation, of a digital.
It's interesting. It's one thing for Jamie Dimon to say that Silicon Valley is coming. It's another thing, as Libor points out, for him to actually give up some profit pools in advance of what may be coming in the next 5 to 10 years.
Let's bring up Jamie Dimon.
I don't know what's in Jamie Dimon's head. I would say that most banks recognize that.
Yeah.
And
recognize
most major banks
will
have
they act on
massive digital organizations that are trying to organize around that concept. Now, whether or not they'll succeed is a totally different question, but they at least have it in their heads.
Yeah, the encroaching world.
let's go. I think we want to move on to some questions that the audience shared with us, so we make sure not to ignore these topics. If you haven't, we have a system here where you can text in your question, so do that if you haven't done so already. Here's the first one. It's about how does the current regulatory and statutory environment foster or limit innovation in tech? And as an ancillary of that, kind of what reforms do you think are needed for disruptive financial services to succeed? I know.
Jake and I were actually talking about this in the green room. I'm going to Jake take a stab at this, because also the conversation has to be about the global economy when you talk about regulation as well, not just the US. It can't be just US-centric, because that would be very myopic. So,
well, since Jake's now part of a public company, we'll start with Baiju, who's at liberty to give a more controversial answer.
So Robinhood is a regulated entity. We have the double-edged sword of being a member of FINRA, SIPC, and we're also registered with the SEC. And I can say that today my perspective on it is very different than it was maybe a year ago. A little bit of backstory: the process of Robinhood becoming a broker-dealer took the better part of a year, put a lot of gray hairs on my head, and put us through a very, very difficult fundraising cycle. And I remember at the time thinking to myself, I don't really understand what this system that we're entering has created these rules for and why it's so complicated. But looking back now, I actually am really grateful that a lot of the regulatory system exists the way it does today in the US. Because in as much as the financial services industry has made mistakes, in 2008, you can say in 2000, and a couple of times in the past, I think it's almost impossible for that to not happen with a system where there are so many incentives. And today, I think our financial system is a lot healthier for having done it. And so from a certain point of view, the regulatory framework is very challenging and makes innovation much harder. From another point of view, it's just another set of rules to follow, and you're genuinely doing some innovative, it really shouldn't be that hard to follow those rules. And I think it does actually go a really long way towards protecting consumers. And just one little example to this point, I remember when we first became a regulated entity, one of the things that we had to do before we were allowed to operate is demonstrate to the regulators that we had on hand enough capital to operate for a full year. Baiju back then was like, that's crazy. Like, how could we possibly have that much money, and like, who would fund us to do this? And looking at it today, I realized that if we hadn't had that kind of capital going into operating our business, we would have done potentially a huge disservice to our consumers. So I'm actually really grateful that a lot of the rules exist the way they do today.
Yeah, I think the rules are there for a good reasons, and regulation in and of itself is not particularly problematic. I do think it'd be significantly more helpful for the regulatory environment to be stable, and to be somewhat more consistent and clean. There's just a lot of overlapping regulations, which can be quite confusing. I was just going through our quarterly testing and review and testing that a lot of us go through, and there's things like systems where you're notified that to be asked if a person is one of your customers, but that itself doesn't mean you should take action. Only like respond that you know them. There's a different system and a different set of rules for doing something about that, and yet another set of rules for suspicious activity and things like that. So there's just a lot of regulations that seem to be overlapping and attempting to solve similar problems, but are slightly different sets of rules, slightly different timelines, different organizations within the government that you have to work with, and simplifying that would be very helpful.
A lot of just one point on that, a lot of the gray area that exists today in the regulatory landscape, and I'll keep this short because regulation is probably kind of boring for all you guys. A lot of the gray area that exists where there are multiple rules that cover a certain thing, or there's really no precedent at all. I think that's an example of something where the onus falls on the entrepreneurs that are starting companies that are operating in that gray area, to genuinely do a good job, not do anything stupid or risky, and demonstrate to the regulators how they should think about these things, because in as much as there are established rules, it does help us to show the regulators like what that means in like a technology era.
Let me ask a new question, unless you guys have a burning point, but I want to make sure we get some of these questions out. Here's a different one. More and more financial institutions are getting hacked, and personal information is getting stolen. Security is an important part of running a financial services business, maybe more so than other sectors. So how do you ensure that you compete with banks who spend billions of dollars and that you're more secure than banks on this front? Nobody.
I'll take it. I mean, we think about working with external parties and to be tested on a regular basis, and to not just one of the things that's kind of telling is when you go through various compliance certifications, it's very formulaic, it's very rubber stamp, and not very ultimately very informative about what your security holes are and aren't. Working in a more kind of forward-thinking manner, working with people who are actively out there working in these spaces, and doing some crowdsourcing of people investigating you from the outside as independent contractors or through other firms, and thinking about how to work with them and get as much information is kind of something constantly on the top of our minds. So making that a way to...
This, I think, is one of the biggest risks to the financial technology space. Not because of any one company may or may not get hacked into any one company being more or less secure. It's that as companies encounter security breaches more broadly, particularly with the financial space, JP Morgan was hacked recently. As that continues to progress, and if we get more of them, consumers will fly from risk, and they'll fly from new companies into established ones. And that's not going to be good for the industry. And I think we should, obviously each company needs to spend a lot of time and a lot of effort on security, but this, I think, is one of the biggest risks to the industry at large. I
do think it's very helpful for the companies involved. Obviously, companies are going to take on that financial risk of hacking, and it is very important to think about sort of the spheres and the rings of access within your internal systems, so that if there is a breach, or if you are hacked, which we presumably eventually, distinct possibility that you will be, limiting the damage and limiting access to within a confined space and damage. So thinking about damage control.
Here's a different one. I like how this is worded. How the HELL does Robinhood make money if there's no commissions? And but also, what are your business models down the line for Affirm and Level Money as well? But Robinhood first.
Sure. Yeah, this is a question that I get asked quite often, and so for that reason, I'm actually going to defer the answer.
Ours is actually really.
No, I'm kidding. So Robinhood is very simply a financial institution that's set up very much like a bank. So Robinhood makes money in all the same way that online brokerages do, except for the one that most consumers kind of at the entry level experience, which is commissions. So when we look at our big siblings, the major online brokerages that are publicly traded today, and we ask a basic question of what does a brokerage business at scale look like, and where does it make money from? The answer is really clear. And the answer is not commissions. It turns out that somewhere between, say, 70 and 90% of the revenue of major online brokerages come from the cash businesses they have. So collecting interest on customers' assets, margin lending, and similar services. And so that's how we see Robinhood, as a company that's going to make money off of all those same lines of businesses, but having a real focus to identifying what the touch points from a cost perspective are for the consumers that really don't have a lot of money, and trying to drive those as close to zero as possible. And truth be told, if we do a good job at providing value to our consumers, and we do achieve the scale that some of our counterparties that are, or our incumbent sort of siblings have, and potentially get bigger, the lack of commissions will not really be a significant part of the business.
I think also you could provide additional tools in terms of advice. And I saw on your site, is it on your site? Or what it is in terms of getting in touch with someone who is a stock advisor. That could be an additional tool that you might be able to provide, a way to monetize the company in a responsible way, but also to help you.
Yeah, that's certainly something we think about a lot. And I think when we take this also comes back to this discussion about education. When we think about financial advice, we try to ask a slightly a question that's like one step backwards, which is, how does an individual, a millennial, if you will, get financial advice? Like, where do these people learn about money, broadly speaking, right? And I think when, as an entrepreneur, we peel away all of our perceptions about how this should happen or how we can use a new mobile interface to make it happen, we really just ask the question, like, what are these people, like, what are people actually talking about, and how are they actually communicating with each other about learning about finances? We see a lot of patterns that are pretty obvious, right? A lot of younger people primarily look to their parents or just one person that's their parents' age that's maybe a relative for financial advice. And that's where a lot of the learning happens. It's not by reading the prospectus from their online brokerage or any of these other things. And so, yeah, we do think that is.
What about you guys, just business model-wise? No.
Ours is really simple. We give people some money, and ahead of time, they and us agree on how much value that has to them and how much they're going to pay us back.
What's your risk, though, on that? Because if you're taking on, I would think you're taking 100% of the risk, yes? What happens when the loan defaults?
I mean, we know what rate they're going to default at, and that's priced into the loan.
What about you, Jay? Because you have a different, I mean, you must have a different business model. You start by giving a free service to users, and then how have you thought about now, maybe even before you joined Capital One, and now that you're with Capital One, making money in the product?
It actually didn't change that much. I mean, in both cases, we thought about this as a component of a next generation banking experience. And the business model for that next generation bank is like a very traditional banking model. You offer checking accounts, you offer loan products, you offer investment products, except we wanted to do it in an honest, transparent, and relevant way. That actually hasn't changed. It's just, got a big brand associated with it now, and the potential to do it a lot faster and a much larger scale than we initially intended.
Ask how they're different from Mint. How are you different from Mint?
We're way simpler than Mint.
All right, good to know.
Yeah, Mint tries to force us into the categories of budgets, or not budgets, but food and entertainment and groceries and all this other things. We found that most people actually don't think that way. They're like, do I have money or do I not have money?
Yes.
So that's how we broke it down, and that's we're going to build it from there.
Two questions here that get asked a lot about two separate spaces, and I'll give them to you as multiple choice, so we get both of them in. How do you think the P2P lending space is changing the financial landscape? And as a separate question, which you can choose to answer if you prefer, what's your opinion about the robo-advisor space?
P2P lending, take that one. P2P lending is an illusion. It doesn't actually exist. P2P lenders, Lending Club, Prosper, people like those, the majority of their loans are actually funded by not individuals, but by other institutions. And in fact, it's actually the same institutions that will be funding Bank of America's loans. And these other things that Bank of America, when they lend you a bunch of, they lend you or make you a loan, they'll package that loan with a bunch of loans like it, and they'll sell it to somebody else. And that happens 5 or 6, 7 times until it hits some overseas pool of capital somewhere that's funding it all. That's essentially what's happening with P2P lenders, except they're taking out all of the middlemen, all of the financial engineering that happens in the middle, and they're allowing that equity or that capital direct access to consumer debt. And in an environment where banks and other things have all kinds of costs associated with that, that's a more economically viable model. So yes, it's changed in the sense that it's a different model for the same concept, but I don't know that P2P lending outside of things like Kiva and other things has a lot of legs by itself.
Yeah.
Agree with that, Libor? I mean, you're building a lending business. Is P2P or marketplace, are these important concepts for you?
I mostly agree with mostly agree. I mean, I think it's about access to capital. People ultimately want access to capital, want to borrow money, and then people want to have money to lend. I think if you just focus strictly on the P2P marketplace, I'll say a risk of being commoditized to a very razor-thin margins between the people who want the loans and people who provide capital for those loans, especially when you have multiple platforms that aren't differentiated amongst each other competing. It's sort of thinking about mortgage lenders. Mortgage lenders are all effectively in the same space. They're backed by the same backstops, and they provide at effectively all the same rates. And who remembers who their last mortgage lender was?
How about robo-advisors to satisfy the, does anyone have a strong opinion on the robo-advisor space? This is companies like Wealthfront or what Charles Schwab is now launching, Future Advisor, these types of businesses.
Not yet. I think I'm waiting to see actually where this goes. We're going to monitor this a bit because I'm not quite sure what they're advising. Well, we're gonna sit back on that answer. We're gonna take a look.
We'll go on to the last question because we're almost out of time here. The question I think maybe we should finish on for the audience is, what's your advice? I mean, what's your advice for entrepreneurs in the audience who want to start a financial services company? Aside from don't do it. But what would you say? What would you say to somebody in the audience who's thinking about starting a company in this space? And we'll go down the line.
Yeah, I think the one piece of advice that I would give is, as an entrepreneur, try to, specifically if you're starting a consumer company, try to understand what consumers actually want, what would make a consumer's life better, and try your hardest to subtract out your own personal inclinations or what you think might be an interesting business model if you paired it with this other thing. Just don't construct those things. Think about what would make a consumer's life much better. That if they were to hear about what you're doing, they'd be like, oh, cool, I get that. And I could see why I want that. And work backwards from there.
Yeah, I'll build on that and say also, when you think about your goals and your strategy, really think about your initial strategy of why is your first user there, why is your 10th user there, why is your 100th user there. We hear a lot of ideas that work great at scale when you have 1 million users, but no idea or plan of how to get there. And so I just stress the importance of when you're really small, why are those first users there?
Look, this is a room full of entrepreneurs, so saying anything other than go get it is probably akin to heresy. But be careful. Be careful because financial services is one of the hardest industries to enter. It's full of shiny objects. There are markets out there that look really good. Payments. Oh, we can put payments on the mobile phone. Checking accounts. We can reinvent the checking account experience. Those are markets that are proliferated with corpses. That honestly, you cannot achieve escape velocity because you can't do the second thing, which is create an experience which is 10 times better than the experiences that exist. Putting payments on the mobile phone just because payments belong on the mobile phone, is not an end to itself. So think about how your experience is going to be 10 times better than the other ones. And then do not underestimate the standards that the consumers in particular will hold you to. It's not okay to enter the financial services industry with a beta product. Give me all your money, but the product's in beta. It doesn't work. Do not underestimate that because, and plan around that. Plan your investment strategy around that, or your fundraising strategy around that, plan your team strategy around that, but do not underestimate the standards consumers will hold you to.
From a VC perspective, I'd say 3 different points. One is your product has to have flexibility and scalability. And in order to have that, you really have to understand whether it's going to play and be able to scale just in the US, or you're going to look at the global scale. And if in fact you are going to look at the global scale, which is one of our criteria for investment, you have to really understand the competitive market and the culture of each one of the countries and how their relationship is to money, to finance. You have WeChat, right, in China, who is now doing these, has created these gifts in red envelopes where you can gift money to each other. You have a lot happening, obviously, in Africa, a lot coming out of the Norway, and what is happening from the UK is that there's a lot of competition out there. A lot of people trying to do the same thing. You have to create a differentiator for yourself, and you also have to create what I feel is the leading barrier of entry, which is proprietary technology. And that is something that you have to really think about, where if you're not fast and furious out of the gate, and the first one's out of the gate, and you can't do it in the most intelligent way, then there's someone right behind you. There are going to be 10 people right behind you, and they're going to be able to duplicate you, not only here, but across the pond. And so those are my thoughts around this, but I also feel that if there are entrepreneurs in this room, you have gained a lot of valuable insight from this panel and from our moderator, and I'm hoping that you guys all go away with some kernel, even if it's just one nugget, we always say, from an event like this.
Yeah, I do agree with that. As I said in the beginning, we have literally 3 of the best entrepreneurs in financial services here. And Jillian, it's been great to have you as well. Maybe we can give a round of applause to the panelists.